China's holdings of U.S. Treasury securities have collapsed to roughly $690 billion, a far cry from the staggering $3 trillion they held back in November 2013. At first glance, it might look like routine portfolio adjustments, a nation simply rebalancing its assets. But this is far more than that. This is not just another financial shuffle. This is a strategic, systematic move that signals the unraveling of the dollar's supremacy on the world stage. What makes this situation truly alarming is that it's not random. History shows that every major collapse of a reserve currency follows a predictable four-stage pattern, and today we are witnessing that pattern unfold in real time. This is the largest coordinated pivot away from the dollar in modern history. Understanding the mechanics reveals a chilling conclusion. This was never a question of if, but when. Consider April 8, 2025. The VIX, often called Wall Street's fear gauge, spiked to 52. To put that into perspective, numbers like this only appear in moments of severe systemic stress, like during the 2008 financial meltdown or the 2020 COVID panic. Markets were sending a warning. This is not something that can be solved with a rate cut or a minor policy tweak. Meanwhile, the United States runs a chronic budget deficit of 6 to 7% of GDP, equating to roughly $2 trillion annually. Foreign nations collectively hold over $5 trillion in U.S. treasuries as of December 2024. And yet, China is quietly laying the foundation for a dollar-free world. With currency swap agreements with 42 central banks, totaling $3.8 trillion in capacity, China has the infrastructure in place to bypass the U.S. dollar entirely. The question isn't whether the dollar will lose its dominance. It's how fast. The collapse of a reserve currency doesn't occur haphazardly. It always follows a four-stage sequence, repeated across centuries. Here's how it works. The setup. A reserve currency nation accumulates enormous debt to foreign powers, far more than it can ever repay. These foreign nations hold the currency because they need it for international trade, using it as a reserve and for settling accounts. Meanwhile, the issuing nation lives beyond its means. It imports more than it exports, consumes more than it produces, and runs deficits it cannot realistically cover. Economists call this the exorbitant privilege, a golden ticket that allows a country to borrow cheaply in its own currency. But the math always catches up. Eventually, promises exceed assets, and insolvency looms. Stage 2. Debasement. Debt mounts, obligations balloon, and the only viable option is to expand the money supply. The government prints more currency to meet obligations it cannot otherwise honor. Interest rates are manipulated, deficits swell, and money creation outpaces economic growth. For a time, this works. Trade continues, confidence seems stable, and the world still relies on the currency. But slowly, quietly, confidence begins to erode. Crisis of confidence. Here is where things turn dangerous. Foreign holders, initially cautious, start to sell. What may begin as simple portfolio rebalancing accelerates into panic. The issuing country scrambles, burning gold reserves, imposing capital controls, and seeking emergency credit lines. Allies are pressured to maintain faith in the currency, but these are temporary band-aids. The fundamental math remains unchanged. When obligations far exceed real assets, collapse is inevitable. Collapse. Finally, the reserve currency is abandoned. Exchange rates fail, international agreements unravel, and a new monetary order emerges. Collapse can be slow and orderly, as with Britain from 1945 to the 1970s, or rapid and catastrophic, as with Germany in the 1920s. Importantly, once Stage 3 begins, no reserve currency has ever recovered. Not once. Today, Stage 3 is already underway. China isn't attacking the dollar. They are positioning themselves to profit from its decline, recognizing an unavoidable trend rather than forcing it. History offers clear proof of this pattern. Take Britain after World War II. Although victorious, the nation was financially shattered. By the end of 1945, Britain owed £37 billion to other countries, yet held only £620 million in gold and US dollar reserves, a ratio of 6-1. Stage 1. The trap was set. Around the globe, Commonwealth nations and colonies continued to hold sterling in reserves, convinced it was as stable as gold. But Britain couldn't meet its obligations, so Stage 2 kicked in. The nation borrowed heavily from the United States and expanded its money supply. In December 1945, Britain signed a critical agreement with the US promising pound convertibility by July 1947. This meant anyone could exchange pounds for dollars or gold, ostensibly restoring confidence. But the promise failed spectacularly. Within a month, the Bank of England had lost $1 billion. Between August 10th and 15th alone, Britain burned through $175 million. Stage 3, the run on the currency, was underway. Foreign holders rushed to convert pounds into tangible assets. The US loan exhausted in weeks. Britain began depleting its gold reserves, and by August 19th, convertibility was suspended. The pound became a controlled currency, propped up by regulations and political pressure, but the underlying financial reality remained unchanged. Sterling's share of global reserves collapsed over the following decades: 81% in 1945, 58% by 1950, 35% by 1960, and just 11% by 1970. Britain devalued the pound twice, first in 1949, then in 1967, and by 1976, it had dropped from $2.80 to $2.40, requiring a $2.3 billion IMF bailout just to keep the economy running. Stage 4. Complete. Sterling was finished as a reserve currency, replaced by the dollar, which by 1970 accounted for 85% of global reserves. The sequence, setup, print, crisis, collapse, was textbook. The second example, the US itself in 1971 during the Nixon shock. By the late 1960s, America faced a problem eerily similar to Britain's post-war predicament. Under Bretton Woods, dollars could be converted to gold at $35 per ounce. But Cold War spending, the Vietnam War, and domestic programs had created far more dollars than the US had gold to back them. Stage 1. Obligations exceeded reserves. Stage 2. Printing. The Federal Reserve expanded the money supply to cover deficits, attempting to stabilize markets. Inflation rose. Foreign central banks, initially patient, began converting dollars into gold. The pivotal moment came on August 11, 1971, when Britain requested $3 billion in gold to be transferred from Fort Knox to the New York Fed. That request was the signal. The world was losing confidence. The dollar's debasement had triggered a run. History teaches that these patterns are not anomalies. They are inevitable consequences of economic imbalance. When a nation issues more currency than it can support with real assets, confidence erodes. Once panic sets in, there is no turning back. Now look at the present. US debt continues to swell, deficits remain stubbornly high, and foreign nations, particularly China, are methodically reducing their exposure to US treasuries. Swap lines and alternative systems are already in place. The infrastructure for a dollar-free global trade network exists, waiting quietly in the background. The warning signs are unmistakable. We are witnessing Stage 3 in real time. The question is no longer whether the dollar-ES dominance will end, it is how rapidly the transition will occur and what role new players, like China, will play in reshaping the international financial order. Just as Britain and the US were caught in historical cycles, the dollar faces its own reckoning. For investors, policymakers, and global citizens, the lesson is clear. History doesn't repeat, but it rhymes, and today it's rhyming loud and clear. The four-stage sequence, setup, debasement, crisis, and collapse, is more than theory. It is a blueprint written by history, now unfolding on a scale larger than anything we've seen before. The dollar-AS era, as the world's reserve currency, is facing its most serious challenge yet. And like every reserve currency before it, the final act is inevitable. On August 15, 1971, President Nixon stunned the world by announcing the suspension of dollar convertibility to gold. What he called a temporary measure quickly became permanent. Stage 3, the crisis of confidence, was underway, and Bretton Woods, the post-war monetary system, was dead. Over the next 2 years, floating exchange rates replaced fixed parities, and the world's monetary order shifted. The dollar survived as the global reserve currency, but only because there was no viable alternative at the time. Gold had been fixed at $35 an ounce. Today, it exceeds $3,000, reflecting a 98% loss in dollar purchasing power over 5 decades. The sequence was unmistakable: setup, printing, crisis, collapse. History had repeated itself. Another example lies in Germany of the 1920s, the infamous Weimar hyperinflation. By 1918, Germany's national debt had reached 156 billion marks, and reparations imposed by the Treaty of Versailles added another 50 billion marks in 1921. Stage 1 was clear: debts that were impossible to repay. Annual obligations alone consumed roughly 25% of GDP, a crushing burden. Stage 2 followed: printing. Taxes couldn't cover the bills, and politically cuts were impossible. The government resorted to pumping marks into circulation. By 1920, the currency had lost 16 times its value against the dollar. Prices soared hundreds of percent within months. Stage 3 struck with brutal force. In January 1923, France and Belgium invaded the Ruhr Valley after Germany missed a reparations payment. Germany subsidized striking workers, printing even more currency. By December, the exchange rate had reached 4.2 trillion marks per US dollar. Bread prices skyrocketed midday, forcing workers to be paid twice a day just to keep up with inflation. Stage 4, total collapse, arrived swiftly. The mark became worthless, replaced by the Rentenmark at 1 billion old marks per new unit. Wallpaper was more valuable than currency. 3 years, and the full 4-stage pattern, setup, print, crisis, collapse, had played out exactly as history predicted. Now, fast forward to 2025. The US is walking a familiar path. Stage 1, the setup, is complete. Foreign nations hold over $5 trillion in US treasuries as of December 2024. US debt exceeds $33 trillion, with $2 trillion in annual deficits. Neither taxes nor growth can cover this gap. Borrowing and printing remain the only options. Stage 1 is done. Stage 2, printing, is also complete. For decades, the Federal Reserve has expanded the money supply to fund deficits, stabilize markets, and prop up financial assets. Quantitative easing, yield curve control, and forward guidance are just a few of the tools employed to create money from nothing. For a time, it worked. Confidence remained, markets stabilized, and trade continued. But the foundations were eroding. Stage 3, the crisis of confidence, is unfolding before our eyes. China has reduced its treasury holdings from $1.1 trillion in 2022 to roughly $690 billion by October 2025. This is not simple portfolio management. China has systematically built an alternative infrastructure, 42 currency swap agreements with nearly $4 trillion capacity, and the CIPS cross-border payment system, now boasting 168 direct and 3,400 indirect participants. Chinese banks are cutting dollar lending to emerging markets. De-dollarization is no longer theoretical. It is tangible, measurable, and accelerating. Stage 4 looms on the horizon. The world is watching as dollar reserves are sold. Alternative payment systems are established. Bilateral currency swaps proliferate, and gold is accumulated. Every step signals preparation for the eventual loss of the dollar's global reserve status. This is not speculation. It is observable behavior unfolding in real time. The crisis of confidence has begun, and history tells us one unflinching truth. Once Stage 3 is underway, it never reverses. Stage 4, the collapse, is inevitable. Not because anyone predicts it, but because the pattern of monetary collapse has never failed. Not once. No reserve currency in history has ever returned from Stage 3 to Stage 1. It simply doesn't happen. When obligations exceed the ability to pay, when confidence evaporates, and when alternatives are built, the old order dies. Timing is the only variable. Optimists argue that the US is different. The dollar is backed by the strongest military in history. The economy is innovative. Technology can solve structural problems, and modern monetary theory allows unprecedented flexibility. Let me be unequivocal. This time is not different. It never is. Britain believed its empire would save sterling. It didn't. Nixon believed American power could preserve Bretton Woods. It didn't. Germany believed printing marks could restore prosperity. It didn't. Mathematical reality governs monetary systems, not military might or innovation. When promises exceed assets, when money is created faster than value, and when confidence breaks, collapse follows, every single time. China's actions illustrate the present danger. This is not a crisis for them. It is a crisis for anyone still holding dollar reserves. Foreign central banks face a choice: hold dollars and hope for stability, or exit early and preserve value. In a rush to the exits, those left behind suffer the greatest losses. China has chosen decisively, from $173 billion sold in 2022 to $50 billion in 2023, $57 billion in 2024, and accelerating sales in 2025. Other nations are watching. Japan, the UK, and others are trimming their holdings. The exodus has begun. America's response will mirror Stage 3 playbooks of history: capital controls to slow outflows, higher interest rates to attract dollar assets, emergency liquidity lines, bilateral deals to dissuade selling, and political pressure on allies. These measures only delay the inevitable. Britain postponed collapse for 3 decades. The underlying math still dictated its eventual demise. The US cannot escape the same fundamental constraints. What you need to understand is the inevitability of Stage 4. The selling has begun. Alternative systems are operational. Confidence is eroding. The only question is whether the collapse will be drawn out, like Britain's decades-long decline, or rapid, like Germany's hyperinflationary implosion. Position yourself accordingly. US. Treasuries are no longer risk-free. Consider hard assets, commodities, and currencies of countries with trade surpluses and low debt. Distinguish between currency, an empty promise, and money, value backed by scarcity. This is why central banks worldwide are buying gold at unprecedented rates. They recognize the pattern as clearly as history does. Reject the notion that this time is different. It never is. The 4 stages, setup, print, crisis, collapse, are mechanical, observable, and inevitable. China did not trigger this crisis. They are acting on an economic reality baked in by stages 1 and 2. Everything they are doing, from selling treasuries to establishing payment systems, is a rational response to a global shift that was unavoidable. History repeats with precision. The difference between those who prosper and those who are devastated is whether they understood the pattern before it was too late. Stage 4 is coming. The question is simple: will you be ready when it hits?